Hey there, it's Mike, and in this video I'm going to be going over insurance coverages that you should have for your rental properties. Let's get comfy. So when I'm looking at insurance coverage, I'm not just talking about the bare bones basics. You're going to have a general liability policy and you're going to have a property policy that's going to cover your building. If you have any contents on site, that's going to be underneath your business personal property coverage. And then you should have business income on that as well. What I'm looking at is taking a deeper dive into your liability limits, but then also 3 specific coverages that I look for on the property side that many times are overlooked and there's no coverage in place or you're underinsured on it. For starters, let's start with the general liability policy. So a rule of thumb when you're looking at your liability protection for your property, bare bones minimum, $1 million per occurrence, $2 million aggregate. If somebody's trying to sell you liability limits less than that, I would recommend going and getting a second opinion. However, when it comes to liability protection, what you're really trying to do is looking at what are the assets and the value of the assets that are owned by that entity. So you may have, let's say, $5 million worth of real estate that's owned by that entity. Well, your $1 million per occurrence limit may not be sufficient enough. If there's a precedence out there for any type of lawsuits that have taken place, you may want higher limits even above what your asset value limit is. So I highly recommend you review this with your agent. Now, a general liability policy, this is a quick hack or side note on this, is some insurance companies will offer a $2 million per occurrence, $4 million aggregate, or even higher than that. The reason why you might do that is it's gonna help save on the cost usually versus going out and getting a separate umbrella policy, which layers $1 million increments of additional coverage above your general liability. There's kind of a lot there. So let me break it down. Let's say you have $1 million per occurrence on your general liability policy. You go out and you purchase a $4 million umbrella policy. Well, now that stacks above your $1 million limit, which gives you $5 million worth of liability. However, some insurance companies do offer higher limits on their general liability. The $1 million per occurrence may not be the highest limit that they can do. And oftentimes it's significantly cheaper by just boosting up that limit on the general liability policy versus going and purchasing a separate umbrella policy. When it comes to property coverage, business income is a big one. And so when we look at business income, usually it may be like a defined limit like $50,000. That may not be sufficient for your property. What I like to see is an actual loss sustained valuation, which pretty much says, okay, we're gonna look at what's the history of this property, what's the revenues, what's the operating expenses, really what's the net operating income that the property is kicking off, and the expenses, and then they're gonna look at that and figure out, okay, this is how much we have to pay out for this claim to keep this owner indemnified. When it comes to indemnity, that's really the purpose of insurance. Is you're not really supposed to make a profit off of an insurance claim, but the goal is to indemnify you, which means to bring you back to the position you were in before the loss occurred. When it comes to business income coverage, you want to make sure that you have enough coverage there. What is common to see is, let's say, a 12-month period on actual loss sustained. That means is that policy will continue paying out up to 12 months. But this is where oftentimes find myself thinking, is 12 months enough? Because realistically, let's say you have a fire on your property and the property has to be demolished. Maybe it's a total loss. Well, how long is it going to take for your architect or engineers to draft their plans? Currently, we're in the Chicagoland area. It could easily take 2-3 months for the planning just to get done with the architect, the engineer, and then submitting for permits. You might be looking another 30, 60, 90 days for that. It can eat up a lot of time there. Maybe your construction period only takes, 5-6 months for that to get completed, but what's their timeline and their availability with the contractors too. So if you can, I like to bump it out even further, maybe 18 months or 24 months on business income, just to give you a little bit of room to breathe there. The next coverage is one that very often is missed, and this is the extended period of indemnity coverage. Like business income, this is a coverage that pays for your loss of income. Where this is really important is, let's say you've gone through, you've completed everything on the site, you've rebuilt the building, you got your occupancy permit, now you're good to go. Well, now what happened to your tenants? Or did they stick around? Were they waiting for the 12, 18 months that it might take to rebuild the building? Chances are they might be long gone, right? They either closed up shop or they may have found another space to move into. And so depending on your lease agreement too, I have seen provisions where there is a termination clause that will allow them to terminate the lease if a total loss or a fire or something like that takes place that shuts down the building. This is something, if you lose your anchor tenant, how long is that going to take you to replace that tenant? Now, granted, you would have a marketing period while you're rebuilding the structure, getting things all in place, but what if you need more time to that? That's where the extended period of indemnity coverage comes into place. And so just like business income, you're able to tack it on for 6 months, 12 months, 18 months, 24 months I've seen. And really this is just continuing to help you out to, again, indemnify you back to the position like you were before and just help you along the way. So once construction is completed, your business income stops, that's where the extended period of indemnity coverage starts. And so you want to make sure that you have that on there, and you want to make sure that you have a sufficient period of time on there. So if you're in the Chicagoland area and you have office space, 6-month period may not be sufficient to fill that space. So you just want to be mindful of what's your asset class, what's the market timeline look like to fill spaces. And again, if you lost your anchor tenant, you may need a little bit more time for that as well. The third coverage that I'd like to look at on the property form is going to be your utility services. And there's actually two parts of this. There's a direct damage and then there's time element. So direct damage is, let's say there's a contractor that's working down the street, they hit a utility line, and that creates a surge that comes into your building and fries your HVAC system, any electrical systems inside the building. So the way that direct damage coverage usually will work is there's usually a defined benefit. It might be $25,000, $50,000. You may be able to buy out more than that, but that's a coverage there that's really for those off-site type of losses. Another thing I'll note there is you want to make sure that you include overhead transmission lines. They do ask that if you want to include them or exclude them. I highly recommend if there's overhead transmission lines in the area that you're including that as well. And then the second part to this though is time element. So utility services time element. This is one for a landlord. I think you should still have it on there. For a tenant, 100%, I would say, depending on your tenancy or your business use. But for utility services time element, this is working similar to business income, where you have loss of income because your building is shut down. Pretty much what do you do during that time? Now, some leases may have a provision in there that if the building is inoperable because of something the landlord didn't provide, a utility service or whatever it may be, after, let's say, 48 hours, the tenant no longer has to pay rent until services get back on, or there might be some other provisions in there. What I would recommend is having a utility services time element coverage on there, and then the deductible is actually the big thing here, because you could have a 48-hour deductible, which means, okay, you're not going to receive any payments from the insurance company for the first 48 hours. Well, if your lease agreements have a 48-hour provision, technically you'd still be getting that from your tenants. But then after 48 hours, now the insurance company is going to pay you, and kind of as the tenants stop paying. So something to be mindful of. Check your leases, see how those were written, and if there are any of those provisions in there. If you are a tenant though, and let's say you're a restaurant, or like Buffalo Wild Wings or a sports bar or something where you have a peak season, what happens to your business if all of a sudden all the power goes out and a surge comes through the building, knocks out all the power, and it's the day before Super Bowl Sunday? What happens to your business? That's a peak season event, and if you have 24, 48, or 72-hour waiting period, you may be in trouble because that day may not count that loss of income because you have that deductible for the first, usually 72 hours is common. So if you're a tenant, I highly recommend get the 0-hour waiting period, just because you don't know where or when that might take place. If it does, hopefully it doesn't, but it's better to buy down, get the $0 deductible. Usually it's negligible on the cost difference between a 0-hour waiting period and a 72-hour waiting period. Same thing for landlords, but I think from a landlord's perspective, at least my philosophy on it is I'm really looking to cover against those catastrophe events that would take out my investment completely. And so when it comes to things like deductibles, waiting periods, I'm not nickel and diming for those items. Usually I'm boosting those up within my comfort and financial ability. Hope this information was helpful. If you have any questions, please leave a comment below. Appreciate your likes. And if you know anyone that might benefit from this video, please share it. Catch you on the next one. Thank you.